not all of the NRIs should invest in India. There is a default expectation that NRIs will at some point invest in India, and I think we should.
What is the type of person who shouldn't be investing in India?
You want an economic return. That is pure and clear and simple. If there is no economic return to you, then you shouldn't invest. Jingoism or politically driven thought processes are the worst reasons to invest in India.
If you're a US or a UK, if you're living in one of these countries, then Indian stocks are the ones that should catch your fancy. Could you explain why this is?
New Zealand, Singapore and UAE have no capital gains tax. So that would be a good thing. But guess what? If those very people were to come to India and buy a stock, a house, real estate or anything like that, the minute they sell it, India taxes them. There is one exception to this.
Let's say that you are someone who's looking at coming back to India. Should you be increasing your allocation to India as you're getting closer to the great move back?
There are many things for this. Let's start with.
Hi everyone, my name is Shrey Chandra and I'm one of the co-founders here at Capital Mind. Over the past few years, many of my friends, relatives and acquaintances have reached out about investing in the Indian stock market. And at Capital Mind, we've opened up investment accounts for them at our PMS and have been through this journey of NRIs and foreigners investing in the Indian markets. Along the way, we've had a bunch of learnings, some mixed results, some people who've had big wins, some people not so much. And we thought this is the right time to bring in Deepak Shenoy to reflect over our last couple of years of learnings on this process and help discuss who's the type of person who should be investing in India and what they can expect along the way. So let's listen in. We have millions of Indians living around the world right now, and they're doing very well for themselves professionally in many cases. They're earning in dollars, they're earning in pounds, they're earning in dirhams, Singapore dollars, you name it, we have people everywhere. Many of them remit some of that money back to India as well, sometimes to help out with family and friends or something else. And I think that if you're an NRI and you're in, well, say, in other parts of the country, or other parts of the world, one thought that has probably crossed your mind is, look, I have ties to India. I probably still have family in India. I visit India every now and then. And maybe in my long-term plan, India is still part of that. And I might see myself coming back one day and living there. So given all these connections, should I also be investing in India? It is, after all, like the biggest population in the world, with the fastest growing economy in the world. And some of our stocks have done really well many points of time in the last couple of decades. So I wanted you to help us think through, an NRI having these thoughts, how should they think about investing in India? Because it's not really straightforward, right? There's taxes, there's exchange rates, there's repatriation rules, so on and so forth. So given this, maybe I'll start with this question. Who should be investing in India? Who is the kind of person who, with all their background, you're like, you know what, you should actually be moving money here, going through and doing all the hard work and getting exposure to Indian assets?
You know, Shrey, this is actually one of the toughest questions to answer because I think there is a default expectation that NRIs will at some point invest in India. And I think we should change that because not all of the NRIs should invest in India. I'll tell you three categories of people that I think would want to invest in India. The first one is very straightforward. No, I've found often that NRIs are often more patriotic than our own countrymen. But
They don't have to deal with the traffic.
So at one level, but also they feel a sense of belonging to their home country and all that stuff. But that's not a good reason. The good reason should be, when you look at it from an economic standpoint, the first set of your statements, which is that India is a big country, it's a growing country, it's a young country, its average age is less than 30, while other countries are aging. You've got fairly good capitalistic society from the perspective of being able to earn if you do invest, because a socialist society doesn't like you to. So more capitalistic from a initiation point of view. There is opportunities of growth where people can actually grow in a big way. It is not oligopolic like maybe Korea has been with only 4 or 5 families, or Japan has been to some extent, or maybe Indonesia also to a certain extent, and so on. So it's now more spread out. It's not just a few things. So you look at it and say, well, you know what, India's growing, their consumer demand is going to grow, people are going to get more disposable incomes, they're going to be able to spend that money when they want to spend that money. There's going to be companies that go out there and serve their needs. These companies are not necessarily the foreign companies, they're the Indian companies that are serving them. Starbucks is not the biggest coffee chain in India, something else is. And who's that something else? I want to find out and invest in it. Because that's where people, Indians are going to drink coffee. It's a third wave. It could be one of the others. Coffee day at some point. Though, unfortunately, that is no longer
Not anymore, yeah.
the big thing. But if you looked at it from that perspective and said, listen, there's an economic reason to invest in India simply because I need something. And this doesn't need to be your only investment. This needs to be one of your investments. You're seeing the economic need for it. Number one, yes, do invest. There are problems in it, but you have the opportunity to, and therefore you can. The second one is where you have maybe deep emotional or financial ties to India. Your family lives here. You need to be sending back money. That money is sitting there idle, needs to be invested. Or you have real estate that you own here and that earns rent, and that you might need that money for something else here. So while it's being instead of just keeping it in a bank account, you're going to instead of putting it in a fixed deposit, you're going to invest it in something. Could be fixed deposits, could be bonds, could be stocks, could be mutual funds. All of these are good reasons to continue to invest in India, simply because you don't want the idle money to stay without
Idle.
earning enough. Yeah. The third, and I think the most important reason, is if you feel you'll come back. Now, a lot of people in the Middle East have to come back simply because Middle East doesn't give citizenship. And even if they do, it's only to a relatively select set of people, and there are rights issues and all that stuff. And you might want to say, listen, I want to spend my final years with my family without having all the burden of the complexities around me. And some of the cities abroad, they do have this sense of, if you're working here, you belong. If you're not working here, this is not such a great place to be. And that manifests a lot as people grow older, is that money is no longer the absolute driving force. So those people are the ones that will come back to India. And now, I mean, look at the West, Canada and the US and the UK. They are constantly saying we don't want immigrant visas. So if you went there on a non-immigrant visa like an H-1B in the US or an F-1, and you thought that eventually this will be a glide path into some kind of an immigrant visa, these countries themselves are chopping off those opportunities. Now, if you're an H-1B today in the US, who is just finished maybe 3 years,
Prospects don't look as rosy as.
yes, so you're probably going to say, boss, I have to go, and I have to go somewhere, and that somewhere could be India. So I might as well start thinking of building my financial future in India, simply because these people are going to not give me any pathway to a permanent visa. So why should I bother building any assets here? I might just transfer the money back to India and build those assets in India instead, because eventually I want to come back. It's going to be increasingly more attractive to come back also because India is growing. That's a different part of the story. But let's say that the coming back was either involuntary or voluntary, and therefore you need to start thinking in rupee terms for your future. So you don't necessarily want to have, I mean, if you're going to be so rich as to own an island in the Cayman Islands, beyond that extreme rich point, if there is a need for you to come back, if there's a feeling that you will come back, uh, or that you want to come back, and you want your investments in India to happen long before you actually moved back, simply because everything is set, boss. I can come here, I can liquidate some mutual funds, get my life started. A lot of very interesting things can happen, because today you can survive in India in a lot lesser with a lot lesser. I was reading recently about how DoorDash was told by Washington State in Seattle and all in Washington State itself, that they had to pay their people a minimum of $26 per hour. So the DoorDash added $5 per package
Delivery.
per delivery as a charges, and deliveries fell 70%.
Well, yeah.
It was like the earnings of the people weren't anymore. So I was thinking of this, how did this $26 per hour come about as a minimum wage? $26 per hour at 160 hours a month is nearly 3,500 to 4,000 US dollars a month. Now, I know DoorDash is a temporary service, but just assume that $4,000 a month is their lowest part of the service. In India, that's 3.6 lakhs per month. 3.6 lakhs per month makes you live a fairly decent lifestyle in India. So if you generated enough income in the US to generate $4,000 a month in the US, you are probably living subsistence level
over there.
at most places. Whereas in India, you are living the life of a king or a queen, or the equivalent
Got it.
this thing. But I think that is also an attractive factor, because then you could create a system which says, well, listen, if I have investments in India that give me, okay, not 3.5 lakhs but 2 lakhs a month, that's enough for me to survive for a long time, which is true. I think 2 lakhs a month today, even in a metro, for a couple or a single person after the age of 60, is a fairly good sum in most places to be able to survive. So your long term thought process can actually be build that financial corpus in India and do it. That's why you need to think of the investment and think of it carefully as how you will structure it, because you have this pathway to come back. So it's either you love you like
You're
India from its economic story, you
already have
have
assets
ties
here
and
and ties.
assets, or you want to come back.
Okay. So those are the three reasons, as you've said, that someone should consider investing in India for. But let's go with someone who's kind of not quite there and is on the border or on the fence. What is the type of person who shouldn't be investing in India, but even though they perhaps are sometimes plagued by these thoughts that maybe I should be doing this, the FOMO hits them every now and then.
I agree with you that the FOMO does, and in fact,
Not
I
now,
think
I'm sure.
yes,
I'd right the moment. I
I
mean,
think
but
this
maybe a year
yes.
ago it did. Yeah. So
So I would say jingoism or politically driven thought processes are the worst reasons to invest in India. I'm not investing in India for political reasons. I am purely economic player that says I can maximize my returns by investing in India, because I know this place. I think it'll grow. I think I'll do better investing here than investing abroad. But I will also want to invest a little bit of my money abroad. So yes, I'll give 10% of my money to these non-India companies, but I think the money will be made in India. Fine, that's my story. But I'm not an NRI. The NRI might have a different thought process, and the NRI shouldn't be thinking, shit, you know what, my mother country, it gave me so much, let's put the money in back into India and therefore help it grow. Or I want, I'm doing charity work anyway, I might as well put my money into India and make it work there. These are wrong reasons to invest. You want an economic return. That is pure and clear and simple. If there is no economic return to you, then you shouldn't invest in the first place, right? The person that has little or no ties. There are lots of people who go here after, during the undergrad or, post grad. They are maybe single kids, or the brothers or sisters, or, whoever they are. All of them are in the US. There is nobody here. And the parents have aged. Some of them have passed on. There are maybe those final remnants of some properties that need to be sold and cleared up. Why should such people even think of investing in India? Many of them don't, but many of them just have assets here, and there is no eventual need, because they just feel they belong here. So they should have something going. But at some point, I think you can use a more globalized approach of thought process, rather than thinking that India is somehow responsible. It's something, it will be responsible for you to invest some of your money in India, because, well, so a lot of people don't realize how big that is. I'll give you an example of maybe one of some people I know. There was two women who, they were in the US. They are in the US, and their mother was the only person here, and she passed away. There was a house that was there, and it was in a fairly, it turned out it had appreciated quite substantially over the years. That house uh, is worth a fairly significant sum. It's like $1 million each,
okay.
for, or more than that, for each of the children. Now, this is not something that is a small amount even in the US. $1 million each is
Is very
reasonable. Yeah.
significant.
So you might have thought, oh, I grew up in this tiny little small road somewhere in Jayanagar in Bangalore, and look, suddenly it's worth like $2 million, right? So you're almost like, oh, in one sense grateful, but in another sense, you're like, should I do something here? Should I just keep some money here and invest it? Well, look, I didn't even know this thing was worth so much. It was worth like 50,000 40 years back, and now it's worth $1 million each for each of us. Should I not keep something? Bad reason. You're not here. You don't have time to manage your money, and
You didn't even notice the house was worth 2 million till
you're in.
recently.
I know. Come on. At some point, you're almost like it's like Providence that's kind of landed this,
So take the
and
win and move
take the
on.
win and move on. The low the other problem is a lot of people have now become US citizens or non India citizens in whichever place they are. They don't have an OCI card, or they may have some. They may not even have a PAN card, so they don't have the ability to invest unless you go to India, apply for a PAN, and now a PAN is to be linked to Aadhaar, and and so by the end of the story, you're almost fighting bureaucratic battles. If you don't want to fight them, don't fight them. So India should be more for a lot of people just exposure. So the way I would get exposure to perhaps China,
Or right now, Korea as well.
Korea, or something like that. Korea, I mean, it's too small, but it
Okay.
has issues.
Okay, we'll see with
But
China.
let's say you're a Korean national, you might want your home country exposure just because you know a little bit about it. So I want like 5% of my money to sit in Korean stocks. Fine, that's 5% of my money. It's a portion of my allocation, and I needn't come all the way to India to invest. I could use Indian vehicles located abroad to invest. And since I could use a fund that invests in India, that is registered in the US, that could invest in India as well. So that is another way to kind of build this
If you have
exposure.
to, if you have
If you have to, I really think the biggest problem, it's not a big problem. We try to attract all sorts of NRIs, and I think we shouldn't. The story is this, and at some point in time you like it, invest. You don't like it, there is no force to invest. You should invest here because this has a great growth story. Other than that, there should be no love for your I'm not investing for the love of my motherland. It's not
you do
part of
good.
my even thought process. I just live here. It's not like that is what's driving me to invest. I'm patriotic, but I'm patriotic when there's an India Pakistan cricket match. In fact, now it feels useless because they
It's
seem
not
to
much of a
be, it's
contest.
not much of a contest. But India, anything cricket match, I'm still Indian, right? So I don't know how it is abroad. I have no idea how the NRI feels about, like, when India's with the USA. If you're an Indian citizen in the US, its chances are there are more of your friends in the USA cricket team than the Indian cricket team. But do you support India or the US? I mean, like I was like my wife and I were kidding. On the USA cricket team is like India C at some level.
Well, they give us a
They
tough
gave us a good
contest.
part. There was a
Okay.
good contest. There's no doubt about it. But interestingly, I think it's the point is leave the patriotism for such stuff,
Okay.
not for the investment and the money
Fair.
management part of the equation.
So, look, I think you've given us a good breakdown of who's the type of person who should invest in India. And you've also talked about someone who perhaps is a bit confused about the matter and who you think should not be investing in India. So, let's say you've made this leap. You've decided for various reasons that you do want to invest in India. Then I think something which comes to mind is you talked about India's growth prospects being great. I think it's undeniable that China had an extraordinary run over a couple of decades. But from every analysis I've seen on the internet, when people talk about it, apparently investing in their stock market from the year 2000 to 2020 or 2025 hasn't been equally pleasant a journey. In fact, the stocks haven't done too well. I mean, or at least not their broad indices, I would guess. So, do you think that if you're again this NRI who has decided to invest in India, I think the next question would be, so where should I be investing? Should it be stocks? Should it be mutual funds within stocks? What type of stocks? Should I be doing fixed income? How about real estate? Maybe the 2 million house will become 20 million. I mean, it costs 20 million to buy a house in some parts of the world. Maybe India will become one of them. So, how do you think an NRI should consider their basket of choices about where to invest in India, asset class wise? And then what's the returns they should expect?
So this is great. I think let me surface that with this. It is complicated, so you don't necessarily need to invest this on your own. You can use the services of a firm to help you, and
I wonder if there's one on
yeah,
this podcast. Yeah.
yeah. But
Anyway.
I mean, of course, we'll talk about that. But given that these challenges exist, how and what do you invest in India, right? So now, let's say you want to participate in their growth story. It doesn't have to be only in stocks or bonds. It can be through real estate, like you talked about. China, the stock market has done horribly because every time somebody does well, the government comes and tells them, you are becoming too big for your boots. So, Mr. Alibaba, please go, and you are retired, hurt, and we will now
Fair.
figure out what to do. You, Mr. Zoom, have to make positive statements. You, Mr. TikTok, have to only talk about China and further the interest of China. Then what the hell? What is a capitalist guy to do? It's like, it's like, excuse me, you're taking away all my positive stock market returns. But TikTok is one of the most famous brands in the world. And yet, the stock market returns or the market returns of a company like that will be ordinary. Alibaba is one of the world's most formidable e-commerce brands, and yet because of these sudden, out of syllabus kind of requirements that have been thrown at it, they have had to lose, some part of this game. The problem really then is India in that boat? I think India is not. India loves its entrepreneurs, although we love to hate them as well. But by and large, we love the fact that now anybody can create a company that can be listed, that those listings can actually earn people significant sums of money, so much that those guys can retire. In fact, the
Or start
first
funds and incubate the next round of companies.
next round of companies, and it's happening on a regular basis, right? So you've got this massive uh, story in the stock market that has both proved itself to a certain extent. You had companies that have listed maybe 25 or 30 years back, the IT companies that have done ridiculously well. There is homegrown auto companies that have done 5,000x return or 500x return or something like that in a period of, let's say, 25 to 30 years. This is actually quite decent in terms of rupee terms and in terms
I
in
think any
dollar terms
currency
as well,
at
in
this.
currency at that. So you've got a fairly good run of entrepreneurs. So I think that investment in India can happen into the stock market, can happen into the real estate market. But let's just say, firstly, the return expectations. I think return expectations have to be tempered by two things. There's a rupee return that you'll get, this 500x, 20x, 30x, whatever it is the rupee return. Then there's the dollar depreciation, because you might want to measure your wealth in dollars or whichever currency you're in.
But we've weakened against most currencies. Like,
We
first
have.
of all, dirhams, like, I think, are pegged to the dollar. And if you were to say we've weakened very much against the Singapore dollar as well, also against the British pound, I assume against the Swiss franc, but that hasn't come up recently. The fact is that against most currencies, we seem to have weakened. Maybe the yen might be one exception,
Yen,
maybe.
yeah, to some extent now, but not 40 years. But yen, yes.
Yeah.
But other than that, I mean, other than maybe the Argentinian, whatever it
But
is,
then I don't think
I
that
mean,
that
yeah,
matters. Yeah.
inflation differential between two countries, and it's just mathematical. You can get the same thing in two countries for a certain price, but this one country, the price goes up because of its inflation by 2%, and another country it goes up by 6%. So India was 6% average inflation for the 2 decades between 2020, 2000 and 2020, and the rupee or dollar inflation for these two decades was only 2% in the US. So if the differential between the two countries is 4%, then the rupee depreciates by 4% a year. It doesn't depreciate by every year by 4%. It will be bunched.
Like last
Three,
year.
yeah,
Yeah.
like four. You'll get 3 years of depreciation in one year,
And then 2 years of presumably nothing. So.
nothing, or sometimes a reversal as well. So what happens then is that the long-term depreciation of the rupee has been primarily about rupee depreciation across, and is about 4% a year, which means that if you had 12% return in in rupee terms, you had 8% in dollar terms. Now 8% in dollar terms is not as much sometimes, like you said. In the early 2000s, this was fantastic. Even though the rupee depreciated, it didn't depreciate so much. The rupee returns were so fantastic when you started that in 2000 to 2010, that it overshadowed anything that the Nasdaq was doing, or even the S&P was doing, perhaps.
Yeah, yeah. In fact, I just looked at, I used investing.com for the data, and I guess the problem becomes, when does your timeline start, right? If your timeline start on Jan 1st, 2000, then 10 years later, India has trounced global markets and is doing extraordinarily well. And then, however, if your history starts on Jan 1st, 2010, then in the last 15 years, not so much. In fact, the global markets have often trounced India. At least the US, it's just left it in the dust. So, which also keeps making me think, like, within India, a long-term investor is someone who you feel can work 3 to 5 years. Here we're talking about decades of perhaps getting the bet either right or wrong, or a decade-long time frame, which really does feel like it's a slightly painful decision to make, or a high-stakes decision to make. But just coming back to that, could you keep talking us through where should you be investing and what returns can you expect from each type of asset class? I sort of interrupted you there. You were at 12% stock market returns minus 4% of currency depreciation. If you're looking at the dollars, you're talking about 8% dollar returns. I think that's where I cut you off.
Yes, and I think given where we are, there is a roughly 8% return in fixed income terms that you might have got in the last 8 or 9 years.
Nominal, of course,
Nominal,
in rupee
and
terms.
4% effective after taxes, after the rupee depreciation. Now, the issue in something like this is that you have to account for this in your, because if you measure yourself in dollar terms, then you have to account for the rupee depreciation that comes and hurts you, right? So your return expectations are, now the question is, can we expect the same kind of A, rupee returns, and B, rupee depreciation? So to rupee returns, I would say if inflation in India is falling, today's data, which is January 2026, has shown an inflation of 2.75% year on year in rupee terms.
With the new data set.
With the new data set, there's an old one which was based on 2011-12 base year. The new one is 22-23, which has shows 2.75. I understand that, fine. The US for the same time, which is January, is 2.4%. So the differential is 0.35.
Almost irrelevant, right?
Almost irrelevant. So therefore, if this continues, that our inflation remains low, we are likely to see a substantially lower differential in rupee terms versus dollar terms, which is earlier a 4% rupee depreciation per year. We might end up with a 2% depreciation per year. This is more or less consistent with what we are seeing in bets being taken on where the rupee will be in 2028 and 2029, where we are currently 90. They're expecting it to become 96 or 97. So 6 rupees in 3 years is effectively a 2% depreciation per year, approximately. Now, this would translate to meaning that if India got 12%, would you make 10% in dollar terms, which is quite significant. Now, I would say over here that you have a problem. Is 12% also a threat? Because India's growth story has been inflation plus real growth. If inflation was 6%, real growth was 6%, you are getting 12%. Now, if inflation is 2 and real growth is 8, you're getting 10. So we might actually see lower headline growth on even the inflation in rupee, on even the assets in rupee terms, unless you invest in certain smaller caps and be selective in that, where I think the return can be significantly larger. We are actually talking of a very small period of relatively low inflation. But if this continues, then both our headline return numbers should fall to 10% on equity terms and maybe 5 to 6% in real estate, fixed income terms. Therefore, in dollar terms, we might still be at the 8% level in dollar terms. This would, I would say, by and large, have a small, so basically tempering down of returns going forward, the broad market. And I don't think this is a permanent situation. To bump up growth from 6% to 8% in real terms is a significant challenge. If we were able to do that with relatively low inflation, I would just say close your eyes and invest. Because forget everything else, a country growing at 8% a year with 2% inflation is going to be in fantastic shape in the next 10 years. That means our demand domestically will grow, our number of local brands, international brands also will grow. More people will invest in India just for this growth, tempering the rupee depreciation even further. And it's entirely possible that you're going to see this growth story produce some massive cash machines, which currently exist in the IT world, but not so much outside. But like cash machines in China would be I don't know, maybe Alibaba, maybe Ant Financial, maybe
Baidu.
Baidu. So they serve the local Chinese economy, but they are cash machines in so many ways. That's a meaningful thing.
Okay. So there's two directions in which I could potentially take this. But before I do, any thoughts about real estate if you're a foreigner looking at the Indian investing landscape? Because I get your point. Maybe we can hope for using the past as a bit of a predictor of the future. 8% in dollar terms over an extended period of time on the Indian stock market. Maybe what, 3 or 4% on fixed income. Real estate could be a completely different kettle of fish. I mean, if you get it right, this could be.
Yeah. And so I think so. Just to belabor the point on the real estate versus the fixed income angle also. India now has one of the highest real interest rates because our inflation is 2.75. Our 10-year bond is 6.75.
So 4%. Yeah.
So there's a nearly, so the US 10-year bond is 3.8 or 4% maybe, or at a 2.4%. So it's a relatively smaller difference. We have a 4% differential. This 4% differential is huge. In fact, overnight rates are also about 5%, 2.75% inflation, fairly large difference. This large difference cannot exist in perpetuity. At some point in time, this has to be brought down. So eventually, our rates will come down. If our yields come down, that has a significant short term impact on fixed income returns, which means if we were to bring down yields from current 6.75 to maybe 5% in the next 2 years, we might see a fixed income return of over 10% per year for the next 2 years.
Well, of course, this is because the duration works to your advantage and your
Yes.
debt gets marked up, which would,
Debt gets
but it would be a one-time
It's a one
adjustment.
time. It's a small short term adjustment.
Yeah.
So I think that's but the other part of it, which is real estate. Real estate is very interesting because I think it's first easier for an NRI to buy real estate.
Which I have to say was baffling to me because as an Indian resident, I could probably like pick up my phone and be invested in pretty much any financial security within seconds, minutes. The house takes work or real estate takes work.
Yes.
But you're telling me that if you're an NRI, the real estate is perhaps in some ways easier than the stock.
Yeah, because the minute you say you're an NRI, RBI will say do this. Some PIS account has to be opened. Some tax has to be reported on every transaction. Some SEBI will say, oh, get persons. Have you got his left toenails? DNA footprint. I don't know. Everything is there. So by the end of it, you're almost like, dude, I'm doing through all these hoops to give you guys money. Are you like serious? And then the fact that they invest in India is a boon. Thank you. But to a certain extent, we made it a lot more difficult. Real estate is much easier. You just come, do your thing, and
well, you have to fly, but other than that, it's not too bad.
Yeah, sometimes you don't even have to fly to buy.
I see.
Because to sell you do, because they expect that the selling can be
that's where fraud happens.
Fraudulent. But when you're buying, you can appoint a proxy. You can buy it on your name. Idea then is just transfer the money and you're done, right? Pay the stamp duty or whatever it is. And typically, when you're doing a deal for a under construction property, you don't even need to do this registration business. You just need to sign an agreement and say, oh, we're done. Let's take my money, go, bye. This is how a lot of real estate companies get a lot of money from the Middle East as well. This is all fine until you get the house and then you're thinking like, oh my God, now I have to do something with it.
Well, you can flip it back to the
So you can flip it back, you can try to sell it back. But the minute you sell it, you have to demand what is called a lower TDS exemption from the income tax department, for which you have to send an application. Now it's all online, but this application says, please do not deduct 20% of my sale value. Please deduct only 20% of my actual tax profit, which I have made. So then, that's the
got
thing.
it.
Now, that's a bit of a hoop, but by and large, real estate has been kind to a large extent. But remember that real estate is a function of infrastructure. The worse the infrastructure, the more expensive the real estate. So you find that if the infrastructure is terrible, real estate prices go up because people want to live closer to wherever
and they're very inelastic in their diversion.
So if you look at Hyderabad, where the real estate is fantastic and the infrastructure is fantastic, and people have built apartment buildings like 40 kilometers away from the city because it takes like 30 minutes to get to the city from wherever. So real estate
probably takes you 30 minutes from your house, 1 kilometer away from the office.
Yeah, I mean, literally to walk to my next door, it takes 30 minutes. So it's Bangalore becomes more expensive in real estate just because of that. But to a large extent, India has been supply constrained in real estate. We don't build as many high rises as we should, and a lot of the real estate lobbies actively participate to reduce available supply. So if you opened out complete available supply and suddenly made supply available, I think real estate would crash everywhere, but they won't let it because they'll be like, okay, release the housing in a controlled manner. And because in India, it is so painful to get this thing. So I think the cost of capital has also been high in general. People have found it difficult to finance their own houses. So there has been a lot of black component, all sorts of things. The real estate market has kind of done okay. And I think real estate is a function of location to that extent. But as India gets richer and richer, and if infrastructure gets better and better, your relative gains are not going to be quite as much. And This is one of the reasons why India is one of the only countries, and I think this is forever going to be the case, where no real estate player is part of a meaningful part of the top 50 or top 100 companies in India.
Okay.
Not for anything else, but because the real estate players end up being so focused on keeping supply constrained and acquiring more and more land and basically reducing their ROC to single digit levels, that they don't make meaningful amounts of money in terms of profit, other than once in a while when the cycle is good, like today nowadays perhaps. But by and large, there will be cycles in which they'll do well, and there'll be cycles in which they'll do horribly. And so, investing in real estate has its perils because of lack of regulation. You can invest in something today; it's supposed to be ready in 5 years. It takes 12 years. After it's finished 12 years, you might still find that there are other issues. You need to keep pumping in money to get things done, get it rented, and all that. Rent, if somebody squats in your house, you have to appoint a lawyer to get them out. It could take another 4 or 5 years. So essentially, there are regulatory pains. Whereas if you own a stock, you own a stock. Nobody's going to. It's very difficult to question ownership of a stock. It's within your demat account. You can sell it whenever you want. You can get the liquidity when you want. You can sell half your shares. You can't sell half a house. So NRIs themselves have started to realize that, boss, if I want freedom, I need to look at financial instruments, not real estate.
Okay, fine. I think that covers that well. I'd like to move on to one thing which changes how an NRI could look at their investments in India based on where they are located in the scheme of things. I believe that if you're a US or a UK if you're living in one of these countries, then Indian stocks are the ones that should catch your fancy. Whereas if you're living in, say, the UAE or Singapore, or you were mentioning even New Zealand, apparently, then Indian mutual funds are some things that you should consider. Could you explain why this is? Is it just taxes?
Yeah, no, I think where you live has a considerable bearing on what you should invest in India if you choose to invest in India. And I think to a large extent, some part of this has been driven by tax norms. So the tax norms in each country matter. New Zealand, Singapore, and Dubai have no UAE, yes, have no capital gains tax, which means that in their own countries, if they make capital gains on anything, they don't pay any tax. So that would be a good thing. But guess what? If those very people were to come to India and buy a stock, a house, real estate, or anything like that, the minute they sell it, India taxes their money. India is one of the only countries that taxes foreigners capital gains tax on investments made in India. Whereas any other country taxes foreigners only on income made in India, not on capital gains. Capital gains always
income made in that country.
Okay. Yeah. So I can tax you on the dividends you earn from your stocks, but the capital gain is not taxed.
Yeah,
so
understood.
There is one exception to this: mutual funds. So if you're a foreigner who comes into India and buys mutual funds, whether as an NRI or through Gift City or whatever, you are not taxed at all if you can prove that you have a residency certificate from these countries because of the DTA. Yeah. This gives the ability for a foreigner living in, or an NRI living in New Zealand, UAE,
Singapore. In fact, there was a case, income tax case on the Singapore thing recently, which is the one where I was just almost like shocked to read this and saying I guess it's settled now.
It's been settled. So the ITAT has actually said that you will not have to pay any capital gains tax in India because of the treaty and because you're a resident of Singapore. So they had to refund the taxes that were deducted in the first place. This is actually quite landmark because now it means that if you bring in money into mutual funds, specifically mutual funds,
from one of these countries, which has the treaty and everything,
and then you don't have to pay any capital gains tax. So you don't pay capital gains tax in India, and you don't pay capital gains tax in that country. This is fantastic. I think this is a very good use of a treaty to reduce your this thing. So you should not bother investing in stocks. You should, because if you invest in stocks, you make capital gains, you have to pay taxes. But if you invest in real estate,
and dividend, you'd probably pay taxes in India. Capital gains, you'd pay taxes in India. Yeah, whereas in a mutual fund, all these just get rolled up and you're enjoying tax-free growth basically till these rules change, which might take some time.
So that's one. But if you're in a country like the US
or UK,
they have laws which says, listen, if you invest in India through a vehicle, which is a passive financial vehicle, like a mutual fund is. So the vehicle as a fund manager, its only business is to invest in stocks. Then we will tax you as if you had sold the stocks on December 31st every year. What does that mean? It means
So this is the US and Canada,
the
I think.
US and Canada law, which says that it's a PFIC, Passive Financial Investment Corporation, thing rule that says that if you invest in a passive financial corporation, we'll mark to market, and you will be paying taxes on unrealized capital gains. Now, the US is making a big deal right now about California trying this stunt on unrealized capital gains.
And according to Twitter, everyone who's a billionaire has left California, but we'll see if Twitter
We'll
was
see.
right or not.
Yes. And whether the law is eventually passed, I don't know if it is.
Yeah, okay.
Netherlands has tried to do it recently where they're trying to tax personal gains. And honestly, there's a company called ASML which makes all the chips in the world, chip making machines in the world, or
And
something
probably a
like
lot of millionaires from its stock
from
as
its
well.
yes.
So this is going to
So
be
this will be
interesting.
very interesting. Are they going to move to like Belgium and sit there and say, okay, boss, don't tax me now? But whatever it is, it's going to. I mean, Norway tried it 2 years ago and they lost.
A
I
lot of
think
people.
a lot of people. Yeah, they. So the unrealized capital gains is a bad idea, but not for India apparently, because if these countries you invest in an Indian mutual fund, you will get taxed as if your returns were realized at the end of every year, except you haven't realized them. Now, what's the difference? You could invest in an American in a mutual fund that invests in India, and that'd be fine. In the UK, you could invest in a UK or
Yeah.
a Scotland-based
Fund.
fund, which then invests in India, and
And
that
you'd
would
be
be
fine.
fine.
Yeah.
You just can't invest in an Indian mutual fund. So, as in,
Yeah.
it's Indian resident mutual fund in that sense. So, if you're from there, what you should do is not buy an Indian mutual fund. And now here's a thing where I'll plug like a Capital Mind kind of a service, which is a PMS, where we, instead of buying mutual funds, we can buy a basket of stocks. So you can buy a basket of stocks. So you'd think, what basket of stocks? How do I figure this out? How do I manage it? Well, yeah, take the top 50 or top 30 or top 20 stocks. Just buy those stocks and stick with them forever, or for not for a
Or you
reasonable amount
rebalance
of
them
time.
every now and then.
Maybe rebalance them once in 2 years, to keep the taxation low. Because India does tax stocks that are invested. So any capital gains will still be charged. So you want to reduce your churn to a minimum. But a firm like Capital Mind, which has a PMS, can actually do this for you as a US citizen without actually having to, buy mutual funds. You just buy a basket of stocks that is actually managed in your name. You'd have to come through a US SEC registered advisor, but the idea would be that the stocks would be held in your name rather than held in the name of a mutual fund which you buy.
And this would give you a fairly significant tax savings, and you'd only therefore pay tax when you actually sell the stock,
Yes.
rather than just on artificially marked up or down December 31st framework every year. I have some experience with the UK, so I'll just give you one a number on that, which is that, as per my understanding, if you're, say, a UK taxpayer, and now they have a residency-based test, I guess, then if you've invested in an Indian, say, mutual fund, or why an Indian mutual fund, even if you've invested in, say, the QQQ or the SPY on the New York on one of the US exchanges, you're essentially taxed at a penal rate of like something like 45% at the highest on your gains. So the way they sort of get you is fine. I won't tax you every year. They have a April 5th, April 6th tax year. But when you sell, they'll just tax you at this extremely harsh rate. As opposed to if you invested in one of their funds, it would be like UK fund. I think it's a much lower rate of
Much
like
lower.
25% on capital gains. That's the extent of my understanding. But on this, so where you live really does determine what you should invest in.
Yeah, in fact, in some countries, I would say that if you come from a country that's an FATF sanctioned country, then don't bother investing anywhere, not just India, but but where you live has a considerably huge bearing on the investment returns that you will get post taxes. And because of the tax treaties, you should consider this. So if you're considering moving from America to Singapore, your whole life will change if you've got investments in India by switching from stocks to mutual funds.
Fair.
Once you finish the switch. So that is one, I think, was the important part. But remember, I think the idea over here isn't to say that this is the right investment to make. By and large, that this is the thing. But whether it is stocks or mutual funds, you're going to need some support because the domestic availability of knowledge on which stocks to buy or which mutual funds to buy is much higher than the ability for someone abroad to make the same kind of
Well,
decision.
you've led me to my next question, and here's the one I want to ask you. I feel reasonably confident that some person sitting in India is plugged in enough that they can take some call on, say, the US Mag 7 or mega caps, or get some sense of what company there is doing well. There's just so much data. There's endless analyst reports. These companies dominate the world globally. It seems that it's not as enormous a disadvantage to be sitting, say, in India and trying to invest in US stocks at least, or global stocks, if I may put it that way to some extent. But what you seem to be implying is if you're sitting in Singapore, UAE, the UK, or the US, and you're trying to predict whether you should buy Asian Paints, Indigo, something like that, you're not on as good footing. Can you elaborate on this, please?
Yeah, I think, it's interesting because I think there are two layers to it. One is the procedural layer and one is the investment layer. So let me look at the procedural layer first. The procedural layer is simple. I want to invest in India. How do I invest? Oh, well, you know what? There's an NRI account you have to open and a PIS and a this and that procedural. Oh, then I buy stocks. Then what? Oh, with the stocks paid me dividend. I have to pay tax on that in India. I have to claim a tax offset in the US. Indian taxes are from April to March. US taxes are from January to December. So I have to mix the tax years and find out what the right taxation is and which offset goes where. And once I do that, then somebody has to help me kind of get this together in terms of reporting. My CPA in the US is asking for reports in a certain format. The tax fellow in India is saying, give me your other stuff in another format. So you got to have something that satisfies the two. Procedurally, it is a pain. And the working with an Indian firm just kind of eases this compliance and paperwork requirement to a very large extent and reduces that much of a pain. This why not just buy a stock or a fund comes down to, dude, even if you did, there would be these problems that would come, and you don't know whether these problems would surface to you now or 5 years later, and whatever it is, you're going to need to kind of.
I can come. I have a lot of my friends who are still abroad in many of these countries talk about, and they say even if they have, say, 5% of their money in India, the admin work around the 5% of their money in India is more than the work that they have to do on the remaining 95% in whatever other country it is. So this is very much a problem. I know India is working at this, but we have our own reasons to make this a little painful and a little because we're skeptical of foreign capital for various reasons.
Oh, yeah, yeah. We've had our run-ins with NRIs who, I mean, the reason why there was a law that, in fact, okay, just as a history, the RBI just like I'm talking about, like in the last 10 days, has finally allowed banks to fund acquisitions. You might think, why the hell can't banks fund acquisition? Don't they always fund acquisition? No, no. Official reason is no, I want it for working capital. I will use that money, then I'll go and acquire somebody. They would never be able to fund acquisition of shares. Now, why?
Yeah.
The answer was that acquisitions were considered a bad thing for Indian banks to finance because a certain guy called Swaraj Paul, an NRI in the 1980s, decided to launch a massive fight for a company called Escorts. The
The hospital?
Well, they also own the hospital, but they're
They did
most
other things. Okay.
they have a bunch of they make vehicle part.
Sure, sure.
They partnered with Yamaha to make Escorts Yamaha,
All right.
and Escorts is a bunch of other things, but they make tractors
All right.
for the most part and some other things. But Escorts was owned by this family, and Swaraj Paul decided he wanted to control it.
Hostile
This
takeover.
family,
Yeah.
hostile takeover, and he was getting financed, and they decided the Indian banks can't finance him, and then they created rules on how much NRIs can hold in companies, which still exist, by the way. They can't own more than X% without,
Even today, other than some
triggering
exempted
fuses
categories and
yeah.
so on.
So now they've eased up these rules now in 2026 after so many years because of our distrust for this NRI coming in and taking over our entire economy wala thing. And NRI is still considered foreign capital, so foreign ownership rules will apply. So whatever that is, I think the problem is that distrust of NRIs has kind of made us create these paperwork layers and made us hate they made NRIs hate us also. It's like, dude, I should live here. You told me that when I was living here, I could open my phone, click something, one Aadhaar OTP would come, and I'm done. I can invest in anything in less than 5 minutes at 2 a.m. in the morning after 3 drinks if I wanted, just because.
I mean, it's
I
probably a terrible
yes,
investment decision, but yeah, okay,
yeah.
okay,
Don't
okay.
invest in anything after 3 drinks, no matter what.
What, yeah.
But whatever it is, you could
Yeah, but
if you
it
want.
was not the case here. ठीक है.
Here it is almost like I could be completely sober, nice, perfectly clear in mind and all that stuff.
And it'll
And
be
yet,
6 months, yeah.
yeah, it'll be 6 months. You have to be in India. Some you have to go to your passport, or you have to go to your consular office, which is the Indian embassy in your country,
Or the consulate,
and
yeah.
show, or consulate in your country, and then show your face there, and they have to say, oh yes, we have seen your face, even though you're on Twitter every day
Yeah.
praising India all the time. It doesn't matter, because you have to prove your in this
Yeah,
in this so we've done this. And yet now, let's say you've chosen to invest. Now there's an economic problem also.
So the administrative point, I think you've belabored this sufficiently. I hope if there's anyone who still after this thinks that they can take on this responsibility, all the best to you. But
Yeah,
it's hard enough
I
for us
mean,
to do. But
I personally appreciate any NRI who has finally managed to open their account in India, because I know how much of a challenge it is. And I'm
Fair.
almost like, listen, I have seen you live. And the fact that you choose to go through this process is like 2 points up in notches
your
by
respect
itself.
for them.
Yeah,
Okay.
it's like
But let's leave the administrative aside. Now let's come to the economic. Let's say someone has magically done the hard work for you, and you have these accounts set up. Why can't they just buy famous stocks that they've heard of?
yeah, now is where the problem is, because now what's famous is perhaps economically
And
challenging.
sorry, and sorry to interrupt, because I've had, and many of my friends here have had very good luck buying famous global stocks that we use constantly. So like
Yeah, I mean,
Microsoft, Apple, Google. I mean,
but
we
that's
can
because you use
almost do
them.
no wrong. Oh, okay.
Because you use them, right? So because if you use them, you're like, oh, I like them. But you know, at some point, you're doing this thing of saying, oh, listen, I use this product, that's why I like it. So Apple, for instance, was a very well used product over a long period of time. It had great periods of great returns and periods of bad returns till I think the early 2010s. It was a crap return on that stock, and after that it started to really scale up after the iPhone
I
came
think
in.
that was
And
2003-4 perhaps is when that tide turned, because
time,
you're
yeah,
getting that confused. No?
this thing. And then you saw a Microsoft have been doing nothing for about a decade,
More
and
than that,
suddenly
yeah.
it started to move backward, back up again. So it's not always a given that over here you'll know enough about a stock, but at least you're a user. From the US, you might look at India and say, oh, look what's looking good. Indigo is on time performance. Let me buy the stock or something else. And then you find out that Indigo has some problem and it is not running its flights and it's down 40% because of something. Because you're not in the territory, so you don't know enough about it, and there's not enough news. You're not a user. Indigo is great in India, but you're not using it outside of India, for one. Then the great stock can be a terrible investment.
The great
If
company can
great
be a
company, yeah. So, for instance, you bought Figma, let us say, a while
I
back.
did, unfortunately.
Unfortunately,
Yeah.
it's a great product. I mean, hand-coded assembly for building the best design
Yeah,
software
well,
in
I'm
the
down
world.
70%, so
And
thanks.
down
Yeah.
70%. Yeah, that's just, maybe it's the hand-coded assembly, but I don't know what it is. But on the other hand, you have, in India, you can come here and say, I love Swiggy for and
You
Swiggy,
came
if
here,
you
you
insist,
used it on your
you use it
break.
on your
It's
break,
magical.
it's
Yeah.
magical. Things magically appear wherever it is, and yet the stock's down 30% from or 20% from its IPO price, or something like that. So there is a big difference in economic return in the short term, at least, from liking and loving a product to the economic return resulted in investing in the stock. And one of the problems here is the lack of knowledge between what you know in the US or as a temporary user of a product to what the actual product or the actual company fundamentals are. And that difference can be the difference between making a big profit on a company and making nothing. So there was a time in which, I remember this very carefully, and I remember looking at the Indian two-wheeler companies, two of them in the early in 2002, and they were looking at nearly a 7 to 10% dividend yield, because they were giving such huge dividends that it was nearly 7% or something like that. And I was thinking to myself that, listen, these are two-wheeler companies. India is a land of two-wheelers. The foreign two-wheelers, even if we allowed them in without a license, they would be so ridiculously expensive
That
that
they
they won't
wouldn't make a
compete.
dent. Yeah.
So why do I have a problem just buying these companies and holding them for the long term? We owned a bunch of stocks. My father had bought Hero Motocorp or Hero Honda as it was called in its IPO in 1984 or 85 or something like that. And so I'd seen the company also grow to a certain extent. But the bigger thing was the fact that you had these, both this and Bajaj had been doing really well at that time. And it was very simple to make that call when you're sitting in India. But when you're sitting outside India, you might be like, listen, if India has to develop, it will become a car oriented country.
Okay.
If it is a car oriented country, what will the two wheeler do? Two wheeler will die. And you're sitting in 2002, you're sitting abroad where you're seeing that two wheeler companies are niche. The big, real
Yeah.
mainstream companies are cars.
Yeah.
Except
Okay.
India didn't evolve that way and still not evolved that way. Even today, we 2026, we sell 5x more motorcycles than we do cars, two wheelers than we do
Fair.
cars.
And if you had extrapolated, say, with some exposure to a foreign country, this is perhaps not something you would have guessed.
Yeah, so today I might look at the US and say, oh, look, this company is doing really well because in the US, India's equivalent X company will do well. I think you have the wrong
Framework.
extrapolation
Yeah,
or the framework. India, what does well is very different from, and then economically also, if it does well from a vision standpoint, it may be a terrible investment. Simply because there's no, I mean, the company doesn't know how to make a profit, doesn't know how to deploy its capital properly, and in many cases you don't understand the business well enough. So you might want to look at using the support of a local firm to be able to get the on the ground data of what to invest in, unless you take something as simple as saying buy me the top 20 stocks, in which case you can use the services of a firm just to get those things together. But you might not need detailed financial information. But the local, and I would say this for any country which I don't think I know very well. I would say if I were to invest in Germany, I can go to Claude and ask for give me German companies to invest in, and then they'll give me a name that is that long that I can't pronounce, and then I won't know what it does, and I don't know how to spell it enough to Google it. So at some point, I would end up with a news that is sitting on the outside. I have no idea, and the data is coming out. So China, for instance, I think I don't know which companies to invest in China.
But I have something to come with here. One of the points that you've been making is that the reason you don't know enough about, say, companies in India is because the Indian brands are still largely local. Their markets are still largely local. So, is one of the challenges that the Indian companies today are mostly catering, or the companies you may consider are mostly catering to, say, the local market? Is that maybe the argument you're making,
That
perhaps?
is a core argument as well, because I think this is what this is a problem right now. Because okay, let's look at this.
And will we then have global brands in the future? Like today, China has this BYD and the Baidu and all that. Well, Baidu is not really global, but at least BYD, fine.
At least BYD,
Yeah.
yes. So okay, yeah, this is a very great point, very important point, because okay, what classifies a big brand? If you look at Nestle or you look at HUL and all that, they're global brands.
Yeah.
They have a bunch of brands that they've come to India. They live in India. They acquire a lot of local brands as well, and then they make them their own. By and large, in the 1990s, if you thought about Indian growth as a consumer economy, the beneficiaries were all foreign companies, which means the Suzuki would benefit from Indians buying new cars. The new set of FMCG companies like Nestle and all that would benefit by, or HUL would benefit by you buying more soaps or shampoos, which is what people were buying at the time. So it was not great to invest in Indian companies as such. So if I'm setting up a new electrical network, I'm going to use, of course, I'm going to use Siemens or Schneider. I'm going to use those companies. So it's the subsidiaries of those companies that would make the money, right? But today, I think a large part of the Indian consumption and service network is owned by Indian domestic firms. Like I said, Coffee Day perhaps was a
Was at one
interesting
point.
force for the coffee consumption play, but there will be more. There's Third Wave. There's a bunch of others. There's a coffee roasters, a bunch of coffee roasting companies. There are a bunch of new brands on the biryani side. MTR is trying to reshape itself. From
Maybe
the
a
retail.
Tata Starbucks would list one day.
Tata Starbucks may, oh yeah, may good list. There is a Tata Chroma, which is another brand which they've got that they haven't listed yet. The large number of local retail chains are all Indian by regulation also, but that's also because India,
T-Mart, right? I mean,
yeah, T-Mart at one level, Reliance Retail at another level. There's all domestic, and Zudio, which is Tata Trent.
Trent, yeah.
Yeah. So these are all interesting retail chains, and they're all domestic. They're all the ones that are benefiting from the growth in the Indian economy, not the foreign brands. So you think of Louis Philippe and Van Heusen, they're not American brands or British brands. They're Indian brands that adopted American non-Indian names to
Because
sell
they could sell,
themselves.
yeah.
Madura Coats created it at the time, and there's a bunch of other brands that are now local and understand the domestic economy.
But Jubilant India is a far better stock than, say, isn't the Domino's in India a bigger market cap than Domino's Global? Or some, there was some anecdote.
At one point there was that they branded local because they thought that the growth in pizzas would be forever, and therefore Domino's would get a big share of it. Guess what? The growth in pizzas has been good, but it's the Swiggies and Zomatos that have come in and said, listen, we'll make hyper local restaurant based purchasing as simple as ordering from Domino's, and they've managed to get the other 100 other wood fired pizzas, coal fired pizza, I don't know, whatever else fired pizza is into the global ecosystem. This is actually a very interesting change in the overall branding ecosystem in India. And I think as a foreign person, you may not be exposed to these brands at all. The problem is these brands aren't local, aren't global. So honestly, a Lululemon is more global than most of these brands that are talked about. You don't know about them, and because you don't know about them, it is actually a problem of us over-indexing on these brands in India. And perhaps that is why a Jubilant was at some point valued so richly in India, because we were like, this is a great brand in India. And everybody is like, dude, it's just Domino's.
Okay.
And, so I'm not valued. So Korea's Hyundai is valued at maybe 5 to 6 times earnings. India's branch of Hyundai is valued at 30 times earnings. Now, why the word there would that be is, okay, India has growth from its story. So, but the global investors looking and saying, listen, Hyundai Korea sells a lot more than Hyundai India. Why am I valuing, why don't I sell my Hyundai India and buy Hyundai Korea instead? Because guess what? Korea will always be valued at 4 times earnings. India has at least a chance of growth that can make it more valuable. So I would rather pay 30 times for a company growing 30% than 4 times for a company growing 2%. So if you have a company growing 2% in Korea, is that more exciting than the growth story in India? These are, I think, challenges that people abroad have.
Okay, got it. Deepak, I'm bringing this towards a close. Last couple of questions on my mind. The first is, so let's say that you are someone who's looking at coming back to India. Should you be increasing your allocation to India as your whatever move back date nears? Should your basically India as a 8%, like how earlier they used to say your debt allocation should increase as you're getting closer to retirement or something like that? Here, should your India allocation increase as you're getting closer to the great move back?
Interestingly, the answer to this is not as straightforward as one would think it is, right? I don't think it's required to do it in a linearly increasing format. There are many things for this. Let's start with some of the basic return complexities. One of the things that when you shift back to India is there are two kinds of people. Some people who may be trying this out and saying, listen, can I fit back into the ecosystem? The other are like, we have to fit back. I want to go back. This is where I want to live. So for both of them, I would say the same thing. The shift back may require a certain amount of capital, and that capital can always be sourced from your dollar assets abroad or non-India assets abroad. You can bring that in when you come in. You might want to build some of it in India as time goes. So you don't actually have to bring back capital. You just come here, there's already Indian capital waiting for you. This can be built over a period of time, sending small amounts of money, building a capital base over time. But I would say the number that you thought in mind is also very different from
Yeah.
a living expenses perspective. So you have to plan that. So let's say you said, listen, in 2 years, I'm going to go back to India. I have an H1B. I'm probably going to last another 2 years here. In 2 years, I want to go back to India at some point. And I know it's going to take me like a year or year and a half to maybe find my bearings, get a job, X, Y, Z. So what do you need in India? You probably have, you may have bought a house in the US. You can sell that and buy a house in India when it happens. So you don't have to worry about the house part. But let's say there was an equivalent income part that you needed to kind of compensate for. Then you're thinking maybe, yeah, well, you know what? I probably need 2 lakhs a month in India to survive. 2 lakhs a
Why
month
not? Yeah.
in India is 24 lakhs a year. 24 lakhs at today's fixed income rates, about 6% a year. Um
On
is
4
about 4
crores.
crores. 4 crores is $500,000. Now, if I were to generate $500,000 to keep in fixed income in India, that would kind of meet my ongoing until I find a job or until I find something to do that earns me income. At least that much is there. So I'm talking $500,000 for that. 500,000. So I may have like saved $1 million. I don't know, but just to give you an example. So if I've saved $1 million, I don't need to bring the whole money back. I can bring in when I move or in the process of moving, build this corpus of $500,000 in India that will allow me to survive. Now, beyond that, I can say I'll go to India, I'll figure myself out, and over a period of time, transfer the rest back to India or transfer some part of it back to India. But regardless, even if you were in India and had no exposure to anything abroad, I would tell you to get some exposure abroad.
So don't bring
So don't
everything
bring
back.
everything back. Bring only the amount that you need. The remaining the exposures, you can pare down the foreign exposure slowly. Remember, it's not a given that America will always perform better. I think this has been a good time. There have been times, 2024, for instance, and of the 2002, 2002 to 2007 time frame, when India has done significantly better, where you might say that it was a better thing to invest in India at that time. So it's not purely economic as in one direction, but I would say in general you need this diversified approach in today's day and age, when almost all the EV is being done outside India, when almost all the AI is being done outside India. I think the future of some of these technologies, the economic returns of investing may be outside India, and therefore we should, be a little more aware that we should have investments outside. So you build this at a slow basis. Now, you may have assets in India already, which you maybe don't want. I'll give you an example. I keep thinking about this and saying, listen, we thought about this. We finally bought a house after a long period of time, mostly because we wanted to live there. I know for sure that after us, my kids probably don't want this house. In the sense of, even if I gave them this house, they would be like, huh, whatever, man. I don't want to live in that locality or this, that.
Or that city.
So that city also, yeah. So even if they came back to India, they might not live in the same place, they might not live in the same city, same whatever. Because of that, you may have bought a house 15 or 20 years back thinking that I'll go back and I'll move there. When you come back here, this is not the place you want to be in. So think of anything you own in India as temporary and financial until you actually move here, when you will actually find the place you want to live in. So you want to readjust to that phenomenon. Third thing is that, given the way India is and the fact that you're rooted now in the outside world, you're going to need money to travel. And the biggest thing, for instance, is having a credit card. India getting an international credit card with relatively large balances is a lot more complicated than to have a US credit card that kind of does this. So maybe for some of these reasons, you want to keep a bank account outside, you want to have a credit card outside. Over time, you can bring that, take that back to the thing. So you want to create some financial infrastructure outside, even after you move back, just to be able to deal with all these complexities. And tomorrow, who knows, the government suddenly says, no, for every credit card spend, you need to give an explanation to the RBI about why you spend on it. I'm not saying that
A
that'll
baby
happen.
step in this direction was attempted a few years ago. So don't give anyone ideas.
Don't give any idea. No, I don't want to. I mean, I hope nobody from that side of the world listens to my podcast, listen to our podcast. But I think the important point here is spread your wings a little.
All right.
In that
So
sense.
then I'll come to my last question. Deepak, what does success really look like? Because what haunts me is, let's say you're the type of person who was whether you're in the US, whether in Europe, Singapore. But in the year 2000, if you had started moving money back to India and investing in India, you look like a genius. Saying that I have a 10-year horizon. When you moved back in the year 2010, you look like a genius for this move. It really worked out for you. But let's say you would start in the year 2010 and were investing in moving money from one of these countries back into India. It was a terrible thing you did. You should have just earned the money abroad, invested it abroad, and moved it back with you. Perhaps not even then fully when you came back, say in 2020 or something like that. So, what does success look like? Is it going to be a return number in an Excel sheet? Is it just having the money in the right country at the right time? How would you, given that you're now balanced at some level, the fact that you're thinking about India is a personal, emotional decision at some level, but the fact is, it also has to make economic sense. So, what is success when there's so many considerations at play?
Yeah, I mean, like you said, success may not necessarily be economic in the sense it could be emotionally satisfying for a person who's extremely religious in the Indian religion form of way. They would find India a lot more interesting from that perspective, and therefore satisfies those things. For another person who perhaps is more used to the generally more organized life in the West, this might sound like a nightmare to live in. So those factors apart, let's look at just the economic rationale and economic success of moving back to India. I think a large part of this is about there is no one size fits all equation, like you said. There is no one size, there's no guaranteed this is what you should do. It's a personal based thing. But because you're thinking of moving back to India, what matters to you is rupees, not USD or not any other thing, right? So you don't care if something does really well in USD, but if the rupee appreciates, your rupee return becomes lesser. You might tell me, Deepak, what is this rupee appreciation business? It's not. You know what? In between 2005 and 2007, the rupee appreciated from 47 to 39, which is nearly a drop of 20% in the USD INR rate, right? And the same thing I would say in 2013, the rupee went to 68, and in a year it was at 55. So it appreciated, well, depending on which side of the equation you look at, there's a 20% difference lower rate that you could say. The equivalent today would be it went to 92 and it would fall back to 75. So that would be a fairly large.
Yeah.
You would actually look at me and say, Deepak, what are you talking about? But guess what? I'm not telling you about stuff that hasn't happened. We've seen 20% changes in the past. It can happen. And if that does happen, your USD returns at 5% a year will be a rupee return of negative 3% a year or negative, this thing percent a year. So I would say that would hurt you a lot more than keeping your money in dollars. So think of the rupee return as your North Star. And the rupee return matters if you're moving back to India. So, in that sense, yes. So the second part is that the opportunities in India may not necessarily be in the investments that you can make through the foreign funds that you own. So, one of the reasons to look at India is also the fact that you can invest in small caps, which you can't easily do abroad. Most foreign funds will invest in the top 50, top 100, top 200 companies, but India's meat of the growth may happen in the next 200 or next 500 companies. So the small cap is where the useful part of India's universe is, and you don't get any access to that outside. So you might actually look at some of those, and that's where the rupee returns matter, because while our headline returns have been 12%, 11%, the small cap returns have been more than that. Small caps have their periods of greatness and periods of nothingness, but over a period of time, they have almost always on a 10-year basis
Done
beaten the Nifty, in that sense. So you might actually got a significantly higher return in rupee terms by investing in small caps. The third thing I would say success, even I hate to say this again and again, but patriotism is not investment. The idea of investing in a growing economy is to be you're excited in the economy itself. And the small cap equivalent could be a friend startup. In fact, Indians now invest in US startups. In fact, that's a big problem now because the RBI said that is no longer LRS. You have to apply for an ODI.
Well, I think it's still LRS, but you do have to
You have
do
to
a
apply
filing for it.
Filing for an ODI and all that. So it's still, yeah. So it's a complicated thing. But the way that Indians are investing in US startups, unlisted startups as well, I think NRIs are very keen to invest in Indian startups which are relatively new because A, they get a wider swath, and second, uh, the growth story may be in the new and unknown territories handled by the friends that you've known. So the associates you've had from college, the relatives you've had that live in India, maybe they are the people who can take your money and grow it in a better way than invested in a public limited company. Whereas you can get the growth from here, and the funding sources from India are increasing day by day. In more and more, you're seeing Indian family offices invest in Indian companies because they have the opportunity to grow. So that might be your other alternative success route. So you get the real estate, you get the unlisted equity, you get the bonds, you get the
Stocks.
stocks. And of these, I would say necessarily listed stocks may be one part, unlisted stocks may be another part, which give you a supernormal return. Real estate has a relatively fixed income component to it that gives you some return. Bonds are boring but more reliable, can help you create the income that you need to survive when you move back. I think these combinations are what you should look at. And success over a period of time is just your personal happiness. In the end, I am perfectly happy being here. I know a lot of people who are not happy being here. Social problems or social complexities aside, I think economically there's a really big case for India growing. As an NRI investing in India, either as you're moving back or because of its economic strength coming up, is positively something that should be on the radar for people who are looking for economic growth, with the caveat that it doesn't this apply doesn't apply to anybody, and don't mix patriotism with this.
So in the end, you are solving a personal problem, but think with your head, not with your heart. Okay. Thanks, Deepak.
Thanks, Jay.
Well, everyone, thanks so much for listening. If you or someone you know is interested in investing in India, then do visit capitalmind.in to learn more about our offerings and see if it makes sense for you. Otherwise, happy investing and see you next time.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.